Invest Africa, proudly brought to you by KPMG.
Hello and welcome to Invest Africa. I'm Nozi Pombanjwa. Now, fiscal planning experts say that a sign of a government that cares about its citizens is reflected by the degree of effort that it will put into thinking and planning for the future rather than just focusing on meeting the demands of the present. How are African governments then planning and budgeting for the future at a time when commodity prices remain subdued, at a time when government revenues remain strained, and of course at a time when social pressure continues to mount as citizens demand improved public services? So on Invest Africa today, we're going to be sitting down with the World Bank Country Director looking at, after South Africa rather, Mr. Guang Shen, and he's here with me in studio to help us better understand the importance of fiscal planning in the African context. Thank you so much for making the time to sit down with us. And you recently come or taken over this position for South Africa just under a year. What's the experience been like thus far around just looking at the fiscal planning trends in the region?
This has been obviously a very interesting year. Obviously, the whole group of Southern Africa countries has been faced this very serious macroeconomic challenge resulting from you could call it ending of the commodity super cycle. But this is not unique for this part of the world. It's a whole of sub-Saharan Africa countries is facing this particular challenge. It's a lot of work. And as you know, the World Bank Group as a whole, we are a development organization, and we provide project finance. We support government in tackle many of the development challenges. And of course, fiscal planning is an important part of these programs. And as part of work, we do macroeconomic monitorings. We support and advise government about fiscal plannings and about expenditures, about debt financings and all this. So this is really a time that we really have to sort of gear up our services and support our client countries.
And it must be a very interesting time for you to be here, because we're looking at, as I said in the introduction, subdued commodity prices, where countries like Nigeria have seen their revenues almost slashed quite considerably because of those oil revenues coming in. Does this put additional pressure in terms of getting the fiscal planning right?
Yes, but I think it's also important to reflect, lessons learned, why we're getting into the current situation. First of all, I think the end of the commodity super cycle certainly affected, like I said, most of South African countries. First of all, I think it's a bad news for poverty reduction, because this is obviously a number one challenge in this part of the world. And Sub-Saharan African countries' income grew only marginally during this period. And we're looking at the moment, the latest projection is that for this year, I think the whole Sub-Saharan African region is going to grow at about 3%. For South Africa, I think our projection is growing at about 8%. Now, this is all below the population growth. So in per capita income terms, we're talking about basic reduction of per capita incomes in Sub-Saharan Africa. So that's a huge development challenge. But then we need to reflect, how do we get here? I think one of the key lessons learned from this process is that the commodity cycle is something that we should have, in a way, protected. It's not going to last forever. At the time when the timing is good, when many of the commodity exporting countries are receiving a huge revenue at the price is high, many of these countries should have built their fiscal buffers. Then you can use the buffer to tackle some of the challenge in the cycle like that.
And so countries that haven't built those buffers, who find themselves in a very difficult situation now, what is the standard piece of advice you would give to these countries at this particular point in time? Is it about going back to the drawing board and rejigging the plan? How do you survive a tough economic environment with a plan that doesn't look like the environment it was planned for?
Sure. Well, essentially, you're looking at several areas. One is on fiscal policy, and one is on what we call structural reform measures. I think one of the things that I want to highlight is that if you see this as a little bit of a mini crisis is both a danger and opportunity, if I translate it into Chinese. And then we see how we can use this particular crisis into an opportunity for improve. And one of the areas on fiscal policy side is that we're looking at expenditures. And there are some inefficient expenditure that will need to be curtailed. In many of the sub-Saharan African countries, including our small neighboring countries here like Lesotho, Swaziland, when the time is good, they build up a very large public sector, very heavy, what we call public sector wage bills. And these are areas that you have to control expenditures, particularly when time is bad.
But what about politics? Because, I mean, the example you give is very, very relevant to the South African context, where the political context is heating up. There's provincial or municipal elections, excuse me, and a national election coming in 2016.
Correct.
Does this make fiscal planning even more difficult and more complex when there's a political or election cycle underway?
Definitely. I think it's certainly the case here in South Africa. It's the case in Zambia. National election is coming up in August. I mean, one good example of that is that, for example, one of the what we call the inefficient expenditure is on very large subsidies on electricity, for example, across the regions. And Zambia was a good example of that. I think there's a need to curtail that expenditures. But at the time of election, it's very difficult. We recognize that. But I think we need to build a basis. And during the election is also a time for political participation. People need to understand what the consequences of this type of public expenditures. We're not suggesting that, you know, at time is bad, you have to cut public expenditure all across the board. Because at the time of bad, obviously there's a vulnerable group of population, you know, the poor people, that will be even suffer more. So the social protection program is those programs that need to actually be protected. But other sort of inefficient expenditure program would need to be curtailed. So and then you look at other possibility or temporary financing of those expenditures.
That's a really interesting take, where the emphasis is on ensuring that the poorest of the poor don't bear the brunt of the fiscal constraints that are going to be taken. I want to come back to the point of the long-term versus short-term approach to fiscal planning. We've seen on the African continent increasingly governments coming up with economic blueprints, national development plans, and many of them spanning a much longer period than the current administration would be expected to stay in power. Is this a good thing, or is it planning without necessarily having the longevity to carry the plan through?
Well, I think in most countries you have two exercises. One is kind of a medium to long-term visioning, which is like, in a way, globally, you can talk about this sustainable development goal, which is looking at the next 15 years. The MDG, the previous global development objective. And then South Africa, you have the National Development Plan, which is also looking all the way to 2030. And recently, we also, the World Bank Group did exercise with China, looking at China 2030. It's a kind of visioning and see what are the trends looking forward in the next 15 years and see what are the challenges. And then you can plan currently to basically to confront that challenge much more ready. But then down to the planning, I think every country typically will have their annual plan. Sometimes they have a 5-year plan. 5-year plan is actually a very common exercise. China does it, India does it. My last country where I posed, Ethiopia does it. So 5-year plan. But all this, I think planning is always necessary. But what is important is that the planning has to be done with evidence. It's evidence-based, has a robust monitoring and evaluation system in place, but also is flexible enough to make adjustments, because annually, if you have a 5-year plan, you need to make the review and you need to see what the challenge, how the external environment change, and make adjustments.
So the adjustment point is very important, because if we come back to the National Development Plan in South Africa, where the growth target to make the plan viable sits at 5%. And we all know that the South African economy is not growing at 5%. So why is it that we have not heard the government coming out and saying, these are the changes that we've had to make to the NDP to still make it achievable, given the new growth context? At what point should there be that communication? I
think it's also a political process. I think it has to be building the consensus. Once a country set up a long-term goal, you still have time to achieve it. But I think as part of the exercise, in fact, the recent economic update we highlighted for South Africa to achieve the goal set out in 2030, the National Development Plan, which is to eliminate all poverty in the country. We project that the country will need to grow at 7.2% per year, which obviously at the moment is unrealistic. Yeah, you're right. I think adjustment we need to make, but making that adjustment is not necessarily or eliminating the goal that you want to achieve, but how about your annual plan adjustment to gradually getting check on the growth path. And typical fiscal plan, I mean, just like in a way, so like your family budget, right? You look at how much you can collect, how much revenue you have. You look at your expenditures. And then if there's a difference between expenditure and your revenue, then how do you finance the deficit, right? So I think these are the areas, there's many sort of factors that you can look into, in terms of revenue. You have to look at the trade-off between if you tax too heavily on productivity sector, then of course the sector may have less incentive to produce. So you have to balance that trade-off. And then on the expenditure side, I think you have to make sure that you protect certain expenditure that are pro-growth, because ultimately if you're growing, then you have a bigger base to collect revenues. But in many of sub-Saharan African countries, we also have the challenge that the tax basis typically is rather low. I mean, country in terms of tax revenue, in terms of percentage GDP ranging from the lower 15% to early 20%, which is very low. So how do you broaden the tax basis is also a key challenge. And one idea that we have in recent study is how do you support the urbanizations? Because the low tax basis partly is because of the informalities.
Right.
Part of the economy.
And a lot of African economies have very large informal sectors.
So I think urbanization, how do you manage urbanization could be one of the sort of key instruments to bring this informality back to formalities. So this deal with land and many things. I
think that's an interesting point, and we're going to take a break on how do we formalize urbanization. And when we come back, we're going to come back on this point. I particularly have an issue with it because in Africa, one could also argue that we've seen mass ruralization where African cities are becoming slums. So to what extent can urbanization be part of finding the answer to a good fiscal plan? Let's take a short break. We'll see you in 2 minutes. Welcome back to Invest Africa. I'm sitting down with World Bank Country Director for South Africa, Mr. Guang Shen. And just as we went to break, we're looking at the role that urbanization policy might play in ensuring and supporting governments as they build good and sustainable fiscal plans. So let's come back to the point of urbanization. Sure. How is this going to, getting urbanization policy right, how does that contribute to increasing the tax base, which of course would speak to the revenues that governments are looking for? Okay,
I think there's several aspects of it. First of all, the whole of sub-Saharan Africa is the least urbanized region in the world, meaning that you're still at a relatively low base in terms of urbanization. Urbanization defined as percentage of population living in urban areas. Well, Europe, Latin America, Asia is ahead of sub-Saharan Africa. So I think there's a good opportunity when you're low basis that you can plan ahead and avoid the difficulty, avoid the mistake, you could say, some other region have encountered, right? So there's several areas. I mean, I think you look at the history of human being, urban development, urban is always the center of growth. Right. There's no country that will move from low income to high income without going through the urbanization process, because it's just the idea of, concentration of ideas and technologies and populations in together. They tend to generate more revenues and more economic benefits. But there are different ways of urbanization. How do you make it sustainable? By bringing urbanization as a really part of the answer to developments. So first of all, making urbanization sustainable, meaning that making urban center as the center of growth. So meaning that creating jobs, creating value chains in the urban area. Then of course, then you created much bigger basis for
But that's the ideal. Right? That is the ideal. And as you explain it, it makes absolute and perfect sense. But is that the experience in Africa? As more Africans move from the rural areas and into the urban centers, are we creating the jobs to absorb them that would then contribute to the tax base? Or are we just having the creation of slums in African cities and having a process of ruralization actually playing itself out?
I think that's a very interesting concept, calling it ruralization. Obviously, that's certainly should not be the direction we're heading to. I think they're a good example of how urbanization works in other parts of the world. And there are experience in countries like Latin America, which among developing regions was the much earlier urbanized, right? You see, still today, I mean, you see large slums in countries in Brazil and other, in Rio de Janeiro, for example. And this is the problem of urbanization. That's why you need to manage it properly. And avoiding informalities is a very important part of sustainable urbanization. That means cities have to provide sort of effective and cost-effective urban services to the population so that they don't live in the peripheral area and without urban services. Land management is very important. Part of the problem of urbanization is the restriction on sort of land transfers, on land value areas. So how to bring that informality into formality is a very important part of the solution on the fiscal side. But I think there's also another area of urbanization that's very important, is to making urban center that is livable.
Right.
You don't want to live in cities that is really growing very fast, but it's very polluted. That's not really helpful. I mean, I think China is facing that challenge after many years of industrialization, and that's what China is tackling.
I think I love this term that I think is linked to that concept. I think it's called green industrialization, and this is the new policy direction that African governments should be looking at. But earlier you also put on the table a very simple analogy around looking at the fiscal plan, looking at the revenue that needs to come in, and of course the expenditure. But in the middle is the debt.
Yes.
And what has been the trend that you picked up in sub-Saharan Africa around our debt compared to our GDP and the size of the fiscal plan?
This certainly has been a challenge, particularly, like I said, at the time of high commodity prices. Most countries should have built up their fiscal buffer, but they have not. So at the time of that, they really quickly deplete their fiscal buffer, and then they resort to external financing or domestic financing. There are two different ways of financing. You can borrow domestically, you can borrow externally. Borrowing domestically does not necessarily solve your total resources envelope, because if those resources are not borrowed by the government, maybe the private sector will have access to it, and they will continue to create economic activities. On external financing, then obviously you have to ensure a sustainable level of debt. And that's typically related to your ability to export if you borrow externally, because that's a hard currency. And I think just over the last year or two, in the World Bank, we characterize countries on several levels of debt stress, from green, meaning it's fine, to yellow, which is moderate risk, to high risk.
And what does sub-Saharan Africa look like? Are we in the yellow block?
We have quite a number of countries, I think, increased from about 10 to about 15 that moved to the yellow block, and about between 7 or 8 moving to about 10 to the high debt distress, meaning that you will have trouble servicing your debt. Then, of course, that would be very destructive to macroeconomic developments and growth. I think this is an area that I think many parts of the world, developing world, have this experience, and then we need to look at their experience in the past and see how we can reflect. In the 1980s, when we recall, there was a huge debt crisis in Latin America, but over the last 10 years, except maybe 1 or 2 countries, many of them seem to manage that much more sustainable. I think there are 2 ways to manage it. One is that typically many of the Latin American countries have passed what they call Fiscal Responsibility Act, which basically is setting a limit on how much the government can borrow in relation to their size of their GDPs. And that will build discipline in the systems. And in the other countries, they set an expenditure limit, which is the case of South Africa here. It's really restricted, I mean, how much money you can spend, which is also a good practice. It really depends on each country's own political environments and their source of financing to manage that. And in the case of South Africa, I mean, much of your government debt is internal.
Right.
So that's much better than, if you rely on external debt. So
does that also mean that there might be an over-exaggeration on the consequences of a potential downgrade in South Africa? If most of the debt is domestic facing, even if South Africa were to get downgraded, the scenario is much better than if the exposure to the external debt market would be much higher.
Sure, that certainly is one factor. I'm sure that is a factor that will be taken into account by the rating agencies. I know there's been a lot of discussion about possibility of downgrading, what impact will be. But if you look at the last 10, 20 years, I mean, the rating on sovereign debt here has not been that high in any case. So it's on that range. So I don't necessarily see, but of course we have to be very careful because that will imply impact on capital flight. But I think that risk is there. I think it really depends on how sustainable. But recently I see there's good opportunity in South Africa. For example, last month you have a trade surplus.
Yes.
Which is a very good signal, showing how to manage that, right? And the other thing is that at this time, when you have depreciation, rent depreciation, and this concern, but it's how to turn it into opportunities. So if you can increase export during this time,
right,
both in terms of your export of goods, but also export of services, and that will certainly position South Africa much more strongly.
I want to bring in the monetary policy issue at this point because we know that there are some central banks that look at manipulation of the currency to do exactly that in terms of increasing their exports. What has been identified as the best way to get monetary policy to support the fiscal plan?
I think that different people may have different views. I think my view is much more narrow. I think central banks should really focus on sort of targeting on inflation control. Sort of, keeping it a much more sort of a simple target is probably much more effective. And leave it to the government in dealing with the fiscal policies and structural policy reforms, really on targeting inflation, controlling inflation, because when inflation is high, it's certainly not good to any sector of the economies. And if you concentrate in one particular area, I think it's make it much easier. Using central bank for debt financing is certainly not something that advisable.
Right. So I want to come to fiscal risks. I mean, there was a time when the biggest fiscal risk could be the potential of a natural disaster or catastrophe on that level. Have fiscal risks changed in terms of their nature and how they present themselves to governments now?
Well, I think every country, as part of your fiscal plan, you have to plan for contingencies. And now with the climate change, worsening situation of climate change, we do see a lot more sort of a natural hazard risk. And I think as part of the fiscal plan, multi-year or single year, you have to plan ahead. And that typically requires, I think the key issue about managing natural disaster is to try to avoid to be totally a responsive manner. You're trying to plan ahead, knowing that this is going to happen. It's just where.
Right.
So you have to have your fiscal buffer. You have to utilize sort of modern financial instrument like insurance, and then you should also try to invest in areas that are vulnerable to natural disaster to reduce the risk for this kind of economic.
And as we wrap up the show, with your experience of overlooking sub-Saharan Africa, is there a government that you think has really come up with an innovative fiscal plan that really looks like a potential model that you think should be emulated and copied by others?
I don't think there's any one single model. That I think every country across the board, have different aspects that they're doing well, and maybe they are constrained on other areas. I don't necessarily see that just one single model one have to follow. I think one has to look at it broadly and see different countries have different sort of the pros and cons of their experience and try to bring the best together. One example of that would be, very similar to that, on improving investment climate. Right? I mean, obviously you can look at the highest ranking countries, typically those are OECD countries. But in Africa, you have countries that are doing reasonably well. Rwanda, Mauritius, and when we look at South Africa by itself, across different municipalities, we also see good practices in some municipalities, but they're not all together. But if you're just looking around yourself and looking at bringing all these practices into one places, then you will be in the top of the market.
Well, on that note, this is how we wrap up the show and the conversation with the World Bank Country Director for South Africa, Mr. Guang Shen. Very, very interesting insights. And I think he's put a challenge before us, and that's to cascade the conversation down to the municipal level and really begin to understand that once the plan has been put together, how is it then executed? And how do we make sure that the contingencies are strong enough to withstand the plan? Thank you so much for making the time to join us. Do remember that if you would like to contribute by letting us know which topics you'd like to see on Invest Africa, all you need to do is just follow us at CNBC Africa or at The Real Nosy. And don't forget the hashtag is Invest Africa. Until next time, it's goodbye.